Welcome to our market view presentation. The first currency pair which we'll be comparing is the Australian dollar and the Great British Pound. After researching and comparing various economic indicators, we are forecasting that in the next 3 to 6 months, the Australian dollar will appreciate against the Great British Pound. We are forecasting a value of approximately 0.615 pounds per Australian dollar. Both the AUD and the pound sterling follow a floating exchange rate system, meaning the currency's value is allowed to fluctuate in response to foreign exchange market mechanisms. This means that governments do not directly intervene in the day-to-day exchange rates and leave them free to market focus. Thus, the following indicators are able to have an impact on the exchange rate of currencies. If these currencies followed a fixed exchange rate system, very little effect would be seen on their value. The first economic indicator we used to assist us in making this prediction was the relative inflation rate of each country. Inflation refers to the rate at which the real price of goods and services change in an economy over time. The rate of inflation may impact the exchange rate between a currency pair, since it reflects the change in a currency's purchasing power. When inflation increases, there is a decline in the purchasing power of a currency. According to the RBA, Australia's central bank, Australia's inflation rate is currently 1%. In comparison, the UK's inflation rate is 0.6%, according to the Bank of England. Thus, both economies have low inflation rates. Australia's inflation is 0.4% higher than the UK's, meaning the long-term purchasing power of $1 Australian dollar is expected to be less than the long-term purchasing power of £1 British pound. This means that those seeking to import Australian goods and services will view Australian exports as being more expensive in comparison, since by converting their currency to AUD, they effectively lose 1% of their purchasing power over time, opposite to 0.6 by converting the currency to the pound. Thus, using inflation rate as an indicator, demand for Australian exports will be lower than demand for the UK's exports. This means that less AUD will be demanded in the foreign exchange market to the pound. Using this indicator alone, it stands to reason that the AUD will depreciate against the pound. As a result of moderately higher inflation, those holding onto the AUD may decide to sell their AUD in preference of another currency with a lower inflation rate, such as the pound, resulting in a supply increase of the Australian dollar on the foreign exchange market. This would serve to depreciate the value of the AUD against the pound, since the supply of AUD at the current price level would exceed demand. Another indicator which we used in making our prediction was the relative interest rate in each country. Interest rate may impact the exchange rate between a currency pair because they are representative of the capital returns an investor can make by holding that particular currency in a bank. High interest rates generally attract foreign investment, increasing the demand for currency. Conversely, low interest rates have the opposite effect.
According to the RBA, Australian interest rates are at 1.5%. Whilst this is an all-time low for Australia, it is still the highest offering when compared to other major countries. As a result, these high interest rates are expected to continue to attract significant foreign investment, since it is more beneficial for an investor to be earning 1.5% on their money than less than 1% elsewhere. This will cause greater demand for the Australian dollar, meaning it will appreciate against the value of other currencies. In comparison to Australia, according to the Bank of England, UK interest rates are at 0.25%. This low-yield investment opportunity creates little incentive for foreign investors to convert their currency to GBP, thus reducing demand for the sterling relative to the demand for AUD. Based on this individual factor, the AUD is expected to appreciate against the GBP. One potential future issue which may impact the exchange rate of AUD is that Australian interest rates are steadily being reduced on the first Tuesday of each month, when the RBA announces interest rate changes. In the next 3 to 6 months, it is forecast that interest rates will drop even further, which may cause some investors to withdraw their AUD and convert it into their own currency, since the reduced interest rate may not provide them with enough incentive to invest. However, it is still expected that Australian interest rates will remain above UK interest rates for the foreseeable future. Using this indicator, it can be seen that interest rates will attract more demand from foreign investors for AUD, the GBP. Thus, it is expected that the AUD will appreciate against the GBP. The third indicator which was used in making our predictions was comparing the economic growth rate of Australia and the UK. The economic growth rate of a country impacts the value of its currency because as the average income in a country increases, the average expenditure on imports and exports also increases. The RBA cites the rate of economic growth in the Australian economy at 3.3% as of 8th of September 2016. In comparison, the Office for National Statistics in the UK cites economic growth as 1.2% annually. As such, Australia has 2.1% greater annual economic growth than the UK, meaning Australians will have comparably more disposable income than those residing in the UK. According to the World Bank, 20% of Australia's GDP consumption component is spent on imports, including imports from the UK. As Australian disposable incomes increase, it stands to reason that this figure will also increase, causing the supply of AUD on the foreign exchange market to increase. Simultaneously, demand from Australia for foreign currencies, such as the Great British Pound, will increase. Thus, as a result of the economic growth rates, it is expected that the value of the AUD will depreciate against the Great British Pound, using this indicator. However, recent news can also have an impact upon the value of a currency. Following a public referendum held across the UK in June of 2016, it was voted that the UK would leave the European Union, an action commonly known as Brexit. This procedure would have a number of economic ramifications on the economy of the UK specifically. Furthermore, the implementation of this policy creates huge uncertainties for investors in the British pound, thus decreasing the overall demand for the pound. If the UK is to officially leave the EU, they will likely face numerous difficulties in making trade agreements with nations inside the EU. In the short term, this poses significant problems. If the UK is struggling to export its products to the rest of Europe, the demand for the pound will obviously decrease, leading to an appreciation of the AUD against the pound. There may also be some issues in terms of immigration into the UK from other nations within Europe, likely slowing the growth rate of the population in the country, and subsequently slowing economic growth as the population may struggle to grow and the labour force weakens. This decrease in production levels and economic growth will likely lead to a lower demand for the pound, and ultimately an appreciation of the AUD against the pound.
The second currency pair which we'll be comparing is the Australian dollar and the United States dollar. Using the same economic indicators as in the previous analysis, we are forecasting that in the next 3 to 6 months, the AUD will depreciate against the United States dollar. We're forecasting a value of approximately 0.735 US dollars per Australian dollar. Inflation rates in the United States are currently at 1.1%, as published by the US government on September the 18th, 2016. This is slightly greater than Australia's 1%. It would stand to reason that this 0.1% difference would cause the Australian dollar to appreciate in comparison to the greenback due to the lesser demand for American exports, thus causing the US dollar to weaken. However, due to similarities in the inflation rate, it is expected that the effects of these seen would be negligible. These inflation rates should not prove to be a major factor in determining the future forecast for this currency pair. As previously mentioned, Australian interest rates are currently at 1.5%, with expected decreases in the near future. In comparison, according to the Federal Reserve, the current interest rate in the United States is 0.5%. This is due to the low employment levels and weak economic growth in the country. This low interest rate will serve to discourage savings in US banks when investors know that they can get a 1% additional return on their investment in Australia. With comparatively higher interest rates, more foreign investors will be attracted to the AUD rather than the USD when looking for a return on their investment, and thus the AUD is expected to appreciate against the US dollar in this regard. The third indicator we looked at was economic growth. As stated earlier, Australian economic growth is currently at 3.3%. In comparison, according to the Bureau of Economic Analysis in the United States, the US rate of economic growth is currently at 1.1%. This measure indicates that since Australian economic growth is greater in comparison to the United States, that Australian disposable incomes will be relatively higher than disposable income in the United States. As Australian households and businesses purchase more exports with their disposable income, the supply of Australian dollars on the foreign exchange market will increase. In addition, since some of Australia's imports will come from the US, an increase in demand for US dollars will simultaneously be expected. With relatively higher economic growth rates in Australia compared to the US, it is expected that the AUD will depreciate against the US dollar.